Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. Pacific on Wednesday, September 6th, 2023. Welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's talk about that. Tonight, we've got something of a loaded show for you. First off, find out what's going on with Sam Bankman-Fried and what he thinks of his air-gapped laptop in prison. And then it's Grayscale's audacious play to get their Bitcoin ETF approved. Is the SEC running out of excuses? We'll also talk about MetaMask's new feature that lets you sell Ether for fiat. Is this a game changer or another scam magnet? Coinbase makes a move in the lending space, but this time targeting the institutional investors. What's their game plan? India's G20 presidency comes under scrutiny for its lack of action on crypto governance. And finally, a Russian lawmaker drops a bombshell about the future of traditional banks in the age of CBDCs. Hold on to your assets. It's going to be a wild ride. Sam Bankman-Fried is currently confined at the Metropolitan Detention Center. He's preparing for his trial, which is set for early October. The charges against him are serious: wire fraud and conspiracy to commit securities and commodities fraud. The U.S. Department of Justice has provided him with an air-gapped laptop in a legal visiting room. The laptop is available from 8 a.m. to 7 p.m. on weekdays and 8 a.m. to 3:30 p.m. on weekends. His legal team argues that the current setup doesn't provide him with a meaningful opportunity to prepare for his trial. They've requested his temporary release, stating that the government hasn't designed a workable plan. Putting on my thinking cap here, it seems that the DOJ provided SBF with what they consider sufficient resources for his defense. Now, the term sufficient is crucial. The government has made an effort to ensure that SBF has the tools that he needs to prepare for his trial. The limitations on laptop availability and the hours are standard for a detention facility. So he's not getting anything special, and he's not being singled out with their denials. Furthermore, the defense's claim that SBF is the only one with complete knowledge of the case is something of a double-edged sword, isn't it? If he's the only one with complete knowledge, that could imply a level of culpability. Why would one man have all the information unless he had a significant role in the alleged crimes? The defense's request for temporary release seems more like a strategy to gain public sympathy rather than a legal necessity. The DOJ provided what any reasonable person would consider adequate resources for trial preparation. The government's plan may not be perfect, but it's far from unfair. The legal team's complaints could be seen as an attempt to manipulate public opinion and distract from the serious charges he faces. So as the case progresses, one has to wonder, is the defense playing the victim card, or do they have a legitimate grievance? Given the serious nature of these charges, it's crucial to consider whether SBF is trying to evade justice by casting himself as the underdog. Now, while SBF wrestles with the DOJ over laptops, Grayscale is wrestling with the SEC, but over something that could change the game for all of us. Hit that subscribe button if you want to stay ahead of these regulatory twists. Grayscale Investments has formally requested a meeting with the U.S. Securities Exchange Commission. The aim is to expedite the approval of a spot Bitcoin exchange-traded fund. This comes after a recent court victory in which the U.S. Court of Appeals approved Grayscale's request for the SEC to re-evaluate its application. The court agreed with Grayscale that the absence of a surveillance sharing agreement was not a valid reason for rejection. Grayscale argues that there are no more rational avenues available to reject the product. The SEC has historically rejected all spot Bitcoin ETF proposals. They argue that applicants have not demonstrated their ability to protect investors from market manipulation. However, the court found that the SEC declined Grayscale's proposal without providing a clear rationale. Grayscale contends that its proposed spot Bitcoin ETF deserves approval due to its reliance on the same market surveillance framework employed by the Chicago Mercantile Exchange. Relevant because the SEC has already considered CME's framework satisfactory for Bitcoin futures ETFs. Jay Clayton, former chairman of the SEC, publicly stated that approval of a spot Bitcoin ETF is inevitable. He mentioned that retail and institutional investors want access to it. Clayton also noted that the dichotomy between a futures product and a cash product can't go on forever. Now, here's what I think. Grayscale's aggressive push for a spot Bitcoin ETF approval is a significant move that could potentially shake up the regulatory landscape. The court's decision to side with Grayscale is not just a win for the company, but a strong signal for the crypto industry. It challenges the SEC's long-standing hesitance and forces them to re-evaluate their stance. The SEC's argument against spot Bitcoin ETFs has always been flimsy at best. Their concerns about market manipulation are increasingly becoming moot points, especially when you consider the advancements in market surveillance. Grayscale's reliance on CME's framework, which the SEC had already approved for Bitcoin futures ETFs, exposes the inconsistency in the SEC's approach. Jay Clayton's comments add another layer to this unfolding drama. His statement that a spot Bitcoin ETF approval is inevitable could be a prelude to a significant regulatory shift. It's a clear indication that even those within the traditional finance regulatory frameworks still see the writing on the wall. Right now, it looks like the SEC is running out of excuses. The ball is in their court, and investors are watching closely. Speaking of changing games, Grayscale isn't the only team on the field. If you're a MetaMask user, you'll want to hear this next bit. Don't forget to turn on notifications so you never miss out. The popular Ethereum wallet MetaMask rolled out a new feature allowing users to sell their Ether for fiat currencies like the dollar, the pound, or the euro. This feature is part of MetaMask's portfolio service and is available in the US, the UK, and parts of Europe. Users can cash out their ETH to bank accounts or PayPal balances. The sell feature is counterpart to MetaMask's existing buy feature, which went live April 2023. The buy feature supports a range of payment options, including debit and credit cards, PayPal transfers, bank transfers, and ACH transfers. MetaMask has partnerships with crypto on-ramp providers like MoonPay, Transact, Sardine, and Banksa. These platforms offer real-time quotes for users looking to sell their Ether. MetaMask aims to reduce the number of intermediaries users have to go through when buying or selling crypto. The wallet supports Ethereum and most ERC20 tokens, as well as several EVM-compatible networks like Optimism, Arbitrum, BNB Chain, Avalanche, and Polygon. However, not all states in the US are supported. For example, New York was unavailable for this feature. This move by MetaMask is a significant step towards financial freedom and autonomy for crypto enthusiasts. It's a direct challenge to traditional financial systems and central banks, which have long held a monopoly over fiat transactions. By enabling a direct fiat off-ramp within the app, MetaMask is empowering users to bypass traditional financial gatekeepers. But there is a flip side. MetaMask has long been a target for scammers, and this new feature could potentially make it even more attractive for nefarious activities. Just recently, scammers took over government websites in countries like India, Colombia, Brazil, Nigeria, and Vietnam, tricking users into sending their personal information to fake MetaMask websites. While MetaMask is working to keep users safe, the risks are real and ever-present. So what does this mean for us? It's a mixed bag. On one hand, it's a leap towards decentralization and financial freedom. On the other, it's a magnet for scammers looking to exploit the system. Either way, MetaMask's new sell feature is a game changer, and it's up to us, the users, to navigate this new landscape wisely. From individual wallets to institutional vaults, Coinbase is making moves in the lending space. Smash that like button if you appreciate these deep dives. Coinbase launched a new crypto lending service targeting institutional investors. This move comes after the company abandoned its retail lending program last year due to regulatory concerns. This new service allows institutional clients to lend money to Coinbase using crypto assets as collateral. Coinbase then offers secured loans to other institutional trading clients. The service is similar to traditional prime brokerage services offered by banks. A recent SEC filing indicates Coinbase has already raised $57 million for this new lending program. Coinbase's previous lending program, aimed at retail customers, was discontinued following objections from SEC officials. The current lending service is tailored specifically for institutional clients who are presumed to have the necessary sophistication to navigate the regulatory landscape effectively. The SEC accused Coinbase of running its crypto trading platform illegally and selling unregistered securities. Despite these challenges, Coinbase is moving forward with its institutional lending service. Coinbase's new lending service is a pivot that could reshape the crypto lending landscape. By focusing on its institutional clients, Coinbase is sidestepping the regulatory hurdles that led to the discontinuation of its retail lending program. The move is a risky one, but one that could pay off handsomely given the growing demand for crypto lending services among institutional investors. The company's decision to abandon its retail lending program last year was a cautionary tale about the regulatory challenges facing crypto companies. But Coinbase's new institutional lending service suggests that the company has learned from its past mistakes. It's a smart move, designed to capitalize on the growing demand for crypto lending services among institutional investors while sidestepping the regulatory challenges that plagued its earlier efforts. This new service also reflects broader trends in the crypto industry. where institutional investors are playing an increasingly important role. As traditional financial institutions continue to view crypto assets with skepticism, services like Coinbase's new lending program offer institutional investors a secure and regulated platform for their crypto-related activities. It's a win-win for Coinbase and its institutional clients, and a sign that the crypto industry is maturing. Switching gears to the global stage, where actions speak louder than words, or in India's case, the silence is deafening. If you're as concerned as I am, make sure to follow us for the latest updates. India took over the G20 presidency in the last quarter of last year. Despite holding this position for 9 months, the country has made no significant progress on global cryptocurrency governance. Former Finance Secretary Subhash Chandra Garg stated that the situation regarding global governance and regulation of cryptocurrencies is practically unchanged since India took over the presidency. Throughout its presidency, top Indian officials, including the finance minister and the prime minister, have repeatedly emphasized the need for a common global regulatory framework for crypto. However, tangible progress remains absent. The finance ministers who were handling cryptocurrencies had their last meeting in July, and there was no consensus on governance. India's crypto tax policy includes a 30% fiat tax on crypto earnings and a 1% tax deducted at source on substantial trades. Penalties range from financial fines to potential imprisonment. This has significantly impacted India's crypto industry. One study revealed that the prevailing tax regime may lead to a loss of about $1.2 trillion in trade volume on domestic exchanges over the next 4 years. The G20 presidency was a global opportunity for India to lead the way in crypto governance. Yet the country squandered this chance, leaving the global crypto community in a state of limbo. This inaction is not just a missed opportunity, it's a glaring sign of the government's distrust towards the crypto industry. The lack of progress is especially concerning, given India's significant role in the global crypto market. The country's inaction sends a clear message to the world. India is not ready to embrace the future of finance. This is not just a setback for India, but for the global crypto community that looked to the G20 for leadership. The stringent tax measures are another blow to the industry in India. A 30% fiat tax and a 1% tax deducted at source are not just deterrents, they're roadblocks. These policies have already driven $3.85 billion to overseas platforms. That's not regulation, that's suppression. The government's stance is contradictory. On the one hand, they acknowledge the potential of blockchain technology. On the other, they stifle its most prominent application, cryptocurrency. This duality exposes the government's lack of understanding and unwillingness to adapt. Lastly, as the world waits for India's next move, Russia is planning a feature that may not include traditional banks. Sound intriguing? Then you're going to want to stick around for this last segment. Anatoly Askakov is a Russian lawmaker and the head of the State Duma Banking Committee. He made a bold prediction. He believes that the digital ruble, backed by blockchain technology, will eventually make traditional banks obsolete. Askakov made these comments during a meeting at the AIF Media Club. He emphasized that blockchain technology is gaining acceptance and central banks, including Russia's, are exploring CBDCs. Of course, no concrete plans have been set to eliminate banks in Russia. The European Money and Finance Forum warns that CBDCs could destabilize the financial system by causing large transfers from commercial banks. Currently, loans in digital rubles are not available, but Askakov thinks that this will change. He suggests that decisions could be made by robots, eliminating the need for banks altogether. In a similar vein, Askakov noted that the Bank of Russia has limited the daily use of digital rubles to 200,000 rubles, or approximately $2,000. He believes that this is to separate the banking system from money, pushing people to the central bank system. Russian banks have expressed concerns about the digital ruble, even sending a letter to the Bank of Russia seeking clarifications. His prediction is a warning shot to traditional banking systems. The adoption of CBDCs and blockchain technology is not just a trend, but a seismic shift that could redefine financial ecosystems. And it's not just Russia. Central banks worldwide are exploring CBDCs, signaling a global power shift. The European Money and Finance Forum's warning should not be taken lightly. The destabilization of financial system is a real threat, especially when the central banks are the ones pushing for CBDCs. It's like giving a matchstick to someone standing in a pool of gasoline. The belief that robots could make decisions in place of banks is not far-fetched. Both automation and AI are already disrupting various sectors, and finance is no exception. The question is, are we ready for a world where central banks hold even more power and traditional banks fade into oblivion? The concerns by Russian banks are valid. The transition to a digital ruble could be chaotic, and the lack of clarity from the Bank of Russia only adds to the uncertainty. It's a classic case of the government pushing an agenda without considering the ripple effects. So what happened? Sam Bankman-Fried is preparing for trial, and he's not happy with the government-supplied laptop. His defense claims that the setup is inadequate, while critics argue that it's a play for public sympathy. Is the defense playing victim, or is there a real issue? Grayscale is pushing hard for a Bitcoin ETF, and they just might get it. A recent court victory points towards a potential change in the regulatory winds. MetaMask launched a sell feature, allowing users to exchange ETH for fiat. It's a step towards financial freedom, but raises security concerns, given the platform's history with scams. Coinbase rolled out a lending service targeting institutional investors. By sidestepping retail customers, they're hoping to dodge regulatory bullets and tap into a lucrative market. India's G20 presidency has been a letdown for crypto enthusiasts. Despite holding the reins for 9 months, India has made no significant progress towards global crypto governance. Lastly, Russian lawmaker Anatoly Askakov predicts that CBDCs like the digital ruble will make traditional banks obsolete. While this could streamline financial systems, it also poses risks to the existing banking structure. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.